The outlook for our economy continues to be promising as businesses in lockdown reopen, but the global backdrop is as complex as ever. Our latest forecasts a quarter of the way through the financial year. Sentiment held up resiliently through September despite the ongoing impact of the Delta strain here and around the world, and despite more evidence of China's economy decelerating. The stress in China's real estate sector briefly saw a risk-off mood hit the markets, but the recovery in the price of iron ore suggests that financial markets are pricing in that impact as being ring-fenced and not a contagion event. As a result, the focus is back on reopening the economies of New South Wales, ACT and Victoria, and growing confidence that interstate borders can be reopened ahead of Christmas, thanks to progress on vaccination rates. Consumer confidence is just above its long-term average, which is remarkable given the stress and trauma of the COVID era, and given the fall in employment we're currently seeing until we've fully reopened. The unemployment rate is still relatively low, but after a temporary pause, should keep falling in 2022, given the high levels of job vacancies and an uplift in business confidence, led by New South Wales and Victoria. Skills shortages are in focus ahead of major infrastructure projects that will ramp up next year, which does seem at odds with the RBA predictions that wages growth and inflation will remain subdued until 2024. Energy prices have risen sharply, with oil at a 7-year high and gas prices impacting Europe and China in particular. The energy shortages threatening industrial production, so adding to supply chain pressures. The implications for central banks is clear. Official cash rates will need to rise more quickly to address inflation risks, and term rates, especially 3 years and beyond, have risen sharply, reflecting this likely outcome. The big question is whether inflation will just be driven by these factors, or if wages growth will also help, adding to a more sustainable growth and a more balanced and prosperous 2022. As long as we achieve jobs growth, then we should avoid stagflation, which would be the worst-case outcome. A key positive for Australia in these rising commodity prices is the impact this is having on trade and exports. We achieved a fresh record surplus of $15 billion for August, which normally would drive the Aussie dollar higher, but that old correlation between rising commodities and the Aussie is on hold for now, thanks to geopolitical tensions, the slowing Chinese economy, and our Reserve Bank positioning themselves at the back of the queue for interest rate rises. So, while we still expect strong demand for commodities ahead, a resilient rebound for our economy, and ultimately RBA rate hikes in 12 to 18 months from now, the Aussie dollar will probably take time to reflect these positives. It's going to be a bumpy and uneven recovery, even though our GDP is expected to grow at least 5% through 2022. But household balance sheets have been buoyed by the property market and accrued fiscal stimulus, so spending into year-end should be elevated. And lastly, equity markets seem to be taking a short breather after the strong gains through to September, and with some thought to where inflation and interest rates will be in a year or two. Overall, the markets are still glass half full, and, like the outlook for the economy, are confident about a highly vaccinated world, but cognizant of the unknowns of living with the virus. And that's the market update from Leveraged.